Dear viewers, my name is Dr. Shad Khandaka, and today I'm going to discuss about the commercial market lecture. Now, before starting the lecture, I will go through some of the learning objectives. So the learning objectives which included in this lecture are: evaluate the functions and activities of commercial banks, identify the main sources and uses of funds for commercial banks, outline the nature and importance of banks' off-balance sheet business, examine the main risk exposures, and consider related issues of regulation and prudential supervision of banks. So the main activity of commercial bank. So when we're discussing about the main activities of the commercial bank, we need to understand what are the importance of banks. High levels of regulation prior to mid-1980s constrained their development and lead to growth of non-banking financial institution. So if you look at the non-banking financial institution before 1980s, in Australian market, they have very strong asset size, but after the deregulation of the banking sector, the commercial bank became more dominant institution in the financial markets. And the largest share of assets of all institutions, but understated without considering the off-balance sheet transaction, managed fund, superannuation, and subsidiary finance, insurance, and companies. Now, if you look at the assets size of financial institution as of 2014, you can see the commercial bank has the largest portion of the asset. In 1990s, about 43.8% of total assets are owned by the commercial bank. However, this size increased to 52% in 2008, and the asset size increased to $2,239 billion from $325 billion. If you look further, we can find that in 2013, the size of asset of commercial bank increased to 57.17%, which is about $3,214 billion in the financial markets. Now, the commercial bank became the single most dominant institution out of all the institutions in the Australian financial markets. If you look the other financial institutions which plays a role in the financial market, which are the building society, credit union, money market corporations, some finance companies, life insurance companies, and so on. But if you look at their asset size and the percentage of total asset out of the all financial institution, you will find their percentage of the total asset are declining. Now, if you look at the building society, the percentage of total asset in 1990s out of all the financial institution was 3.1%, whereas in 2013 it became only 0.41%. The same goes for the credit union, money market corporations. However, there are two exceptions. One is the superannuation. Because of the compulsory superannuation in Australia, the size of the super fund is growing. So if you look into the total asset size, in 1990, the total asset size of super fund was $80.8 billion, which was about 10.8%, which became $1,259.7 billion, which is 22.41%. Alright, so this particular institution is growing, and the another institution is which is also sustaining, or I can also say that still not decreasing that much. So what are the main activities of the commercial banking institution? So the commercial bank practiced a system called the asset management before 1980s. So what does it mean by the asset management? So the asset management is basically the loan portfolio is tailored to match the available deposit base. So the bank will only provide the loan to their client only if they have sufficient deposit base. But after 1980s, the banks start practicing a system called the liability management. So the liability management is the deposit base and other funding sources are managed to meet the loan demand. So the liability management also includes borrowing directly from the domestic and international markets, provision of other financial services, and the start of off-balance sheet business items. So if you look into the different types of sources and the use of the fund for the commercial bank, that will give us some more idea about the bank balance sheet. So the sources of fund appears in the balance sheet as either the liability or the shareholders fund, and the bank offers a range of deposits and investment product with the different mix of liquidity, return, maturity, and cash flow structure to attract savings of surplus entities. So when we look into the sources of the fund for the bank balance sheet, which includes the current account deposit, call or demand deposit, term deposits, and the negotiable certificates of deposits. But it also includes the bill acceptance liability, debt instrument, which includes debentures and unsecured notes, foreign currency liabilities. Now we're going to look each of this item again, and we're going to understand a quick definition of each of these items. So the first is the current account deposit. So the current account deposit is an account that everyone we normally have in a bank. In some bank it's called the streamline account, some bank it's called the current account. So in this account, funds are held in check account, which is very highly liquid and maybe interest or non-interest bearing. But generally the current accounts deposits are non-interest bearing, and if it pays any percentage of interest, that will be very insignificant. People normally have the ATM and IFPOS card, and they can withdraw the money using the ATM, or they can go to the bank to withdraw the money. The second type of account, what we can see in the bank, is the call or demand deposits. So funds held in a savings account that can be withdrawn on demand, so you need to give a notice, a short notice, and generally the customers have a passbook or electronic statement account with the ATM and IFPOS facility, so you can withdraw the money on demand. And the third sources of the fund for the bank include the term deposits. So term deposits are that types of account where the funds are held for a longer period of time. So the fund lodge in an account for a predetermined period at a specified interest rate. So at the term deposit, the terms are generally 1 month to 5 years. However, it has some loss of liquidity because of the fixed maturity. Term deposits generally provide higher interest rate than the current or the call account, and the interest rates are generally fixed. As this is a stable sources of fund for the bank generally provide higher percentage of interest. Negotiable certificates of deposits, which can also called as CD. So this is a paper issued by the bank on its own name, issued at a discount to the face value. So this is the discount security. Now, as you know, that the definition of discount security is the face value is below the price in the market, and this is a short-term instrument for the bank, so it's typical for 30 days to 180 days. This is a highly negotiable instrument, and it specifies repayment of the face value of the CD at maturity. Now we'll know more about the negotiable certificates of deposit in our another chapter called the money market. Bill acceptance liability. This is another source of fund for the bank, which includes bill of exchange. So the bill of exchange is a security issued into the money market at a discount to the face value. So this is again a discount security. The face value is repaid to the holder at maturity. So the bank accepts primary liability to repay the face value of the bill to the holders. Issuer of the bill agrees to pay bank face value of the bill plus a fee at the maturity date. Acceptance by bank guarantees flows of fund to its customer without using its own fund. So this is an attractive type of instrument for its customers. Another type of sources of funds for the bank includes the debt instruments, which is the debentures and unsecured note. Both the debenture and unsecured note, these are bond. However, a bond supported by a form of security being a choice over the asset of its issuer is called the debenture. On the other hand, an unsecured note bond without any supporting guarantee or security. And the other source of the fund for the banks includes the foreign currency liability, which is the debt instrument issued into the international capital market that are denominated in a foreign currency. Now, there are some other sources of fund which includes loan capital and shareholder security. So these are the different types of sources of the fund for the bank. Now the uses of the fund for the bank includes basically three basic things. 1. Personal and housing finance. 2. Commercial lending. And 3. Lending to the government. And the uses of the funds appear in the bank balance sheet as an asset. So the uses of the fund includes personal and housing finance, which includes basically mortgage and amortized loan, investment properties, fixed term loan, and credit cards. Now when we are looking to the mortgage finance or the housing finance, there are two different types of housing finance as it's mentioned in here. One is the mortgage and another is the amortized loan. However, please remember the amortized loan is also a mortgage finance which includes principal and interest during the payment. Commercial lending. Commercial lending involves bank asset invested in a business sector and lending to the other financial institutions. Now, the bank can invest in a fixed term loan, for example, a loan with the negotiated terms and conditions. So, when we're talking about the negotiated terms and conditions for the commercial lending, we should include period of the loan, interest rate, which might be variable or fixed for the bank, timing of the interest payment, and repayment of the principal. So these are the commercial lending. So the commercial lending can include that the bank invest bank fund for the commercial investment purpose. So the commercial lending includes overdraft, bank bill held, commercial bill, rollover facilities, and it also includes lending to the government, which includes treasury note, treasury bond, and other bank assets. So if you look into the definition of each of this item, overdraft is a facility allowing a business to take its operating account into the debit up to for an agreed limit. Bank bill held, bill of exchange accepted and discounted by the bank and held as an asset. Commercial bill, bill of exchange issued directly to the business to raise finance. Rollover facility, this is bank agreed to discount a new bill over a specified period as an existing bill to mature. Treasury note is a short-term discount securities issued by the Commonwealth government. Treasury bond is a medium to long-term securities issued by the Commonwealth government that pay a specified interest coupon stream, and other bank assets. Now, as we have seen the sources and the uses of the fund for the bank, We also need to understand what are the off-balance sheet business for the banks. Now, off-balance sheet business or OBS transactions are significant part of the bank business. The off-balance sheet business transactions can include direct trade substitute, trade and performance related items, commitment, foreign exchange, interest rate, and other market rate related contracts. So now we are going to look each of these off-balance sheet transactions and the definitions. Number one is the direct credit substitute. Direct credit substitute is an undertaking by a bank to support the financial obligation of a client, that is a standby letter of credit. So the bank acts as a guarantor on behalf of a client for a fees. Client has a financial obligation to a third party, and bank is required to make a payment only if the client defaults on the payment to the third party. So let's take an example about the direct credit substitute. Think about the garments product what we're using. Think about the shirts what we are wearing or the jeans pant what we are wearing. Which countries they produce? If you look, the name of the country which produced this product, you'll probably find that these products are coming from either Bangladesh, Sri Lanka, Vietnam, China, these countries. However, when an Australian company, for example the Kmart or Big W, give an order to a company located in Bangladesh, what do you think how long is going to take for that particular company which is located in Bangladesh to produce the product? For example, Kmart given an order of 100,000 t-shirts or 100,000 jeans pants to a Bangladeshi company called XYZ. Now to produce 100,000 pieces of the jeans pant, it might take 6 months for that particular company. However, during the processing time, if the Australian company became bankrupt, how the Bangladeshi company is going to survive? Who is going to take the financial burden of this order? So the Australian company, for example the Kmart, has to come out with a standby letter of credit from its own bank as a support for the order. In this case, the bank acts as a guarantor on behalf of a client for fees. As the bank is taking the responsibility of any financial disruption, so the bank is charging a fee to its client, which is the Kmart. And the client has a financial obligation to a third party. So in this case, the Kmart, has a financial obligation to a third party, which is XYZ Corporation in Bangladesh. So this is an example for the direct credit substitutes. The second part is called the trade and performance related items. So this is a form of guarantee provided by a bank to a third party, promising financial compensation for non-performance of commercial contract by a client. So for example, documentary letter of credit, performance guarantee. So for example, think about your employer is building a new high-rise building for the production, and your employer is giving this contract to a well-known contractor in Melbourne. However, for any particular reason, the contractor became bankrupt, or the quality of the product, which is the building in this case, is not the same as promised. So who will give the compensation in this case? So in that case, the bank will come with the financial obligation, or the bank has to pay the compensation, so which is called the trade and performance related items. Another types of off-balance sheet business item includes the commitment. So the commitment is the contractual financial obligation of a bank that are yet to be completed or delivered. For example, bank undertakes to advance fund or make a purchase of asset at some time in the future using the forward purchase or underwriting activities. So this is another types of off-balance sheet business. And the last types of off-balance sheet business includes foreign exchange, interest rate, and other market rate related contracts. So what is the volume of off-balance sheet business? As of March 2013, the notional value of the off-balance sheet business item undertaken by the Australian bank is about 4 times of the value of the total assets. So think about it. The total size of the Australian bank asset is about $3.2 trillion as of 2018. And the size of the off-balance sheet business item is about 4 times the value of the total assets. So this is an enormous business for the banks. And the major commercial banks have the largest share of the off-balance sheet items. However, some foreign banks are also prominent in the field, and over 94% of the off-balance sheet items is based on the market rate related transactions. So in this slide, we look at the volume of off-balance sheet business. So we can see that the largest part of the off-balance sheet business item includes interest rate contracts, foreign exchange contracts, and some trade and performance related items. This is to note that APRA is responsible for the prudential supervision. However, there are regulations and the prudential supervisions which needs to be implemented in order to have a healthy economy. So the prudential supervisions are the imposition and monitoring of standards designed to ensure the soundness and stability of the financial system, control the money supply and growth. In Australia, there are 4 different types of institutions that are looking after the regulatory structure and the prudential supervision, which includes the Reserve Bank of Australia, which is called RBA, Australian Prudential Regulation Authority, which is called APRA, Australian Securities and Investment Commission, which is called ASIC, and Australian Competition and Consumer Commission, which is called ACCC. If you want to know more about the Australian regulatory institution, please look at my previous lectures on the capital markets. Now we'll talk about the capital adequacy requirement of the banks. So when we'll talk about the capital adequacy requirement, we need to look at the Basel I and II. Now Basel III has been implemented, the capital adequacy requirement. Basel I has been established in 1997 by the G10 countries. Bank for International Settlement, in short, which is called BIS, developed International Capital Adequacy Requirement in 1998, which has been adopted by all major industrialist countries, including Australia, and the banks required to hold minimum 8% capital to risk-weighted asset and off-balance sheet item in order to make sure that it is running smoothly. So, Basel II Capital Adequacy Accord is the extended version of the Basel I to increase sensitivity to the different level of assets and off-balance sheet item risk. Now, there are 6 main elements of the Basel VI, which includes the credit risk, the market risk, the operational risks, from and quality of the capital, risk identification, and transparency. Please look into the definition of each of the main elements of the Basel by looking to the textbook. So in this slide, we'll talk about the capital adequacy standard. So minimum capital adequacy requirement applies to the commercial bank and other institutions specified by the prudential regulators, and the minimum risk-based capital ratio is required for every single bank to have its own balance sheet is 8%. Out of this, minimum 4% held as Tier 1 capital, which is also called the highest quality core capital, and the remainder can be held as Tier 2 or the supplementary capital. Now the Tier 2 capital has lower Tier 2 or upper Tier 2 capitals. Now remember, this is based on Basel II capital adequacy requirement. The next two slides will provide some definitions of Tier 1 and Tier 2 capital according to the Basel II capital adequacy requirement. Please look at this definition of Tier 1 and Tier 2 capitals to understand more about these issues. However, please remember, Tier 1 capital includes those types of assets that are very highly liquid, and Tier 2 capital includes those instruments which are below the Tier 1 capital, which is less liquid than the Tier 1 capitals. Dear students, please remember there is a calculation on the Basel II capital adequacy requirement. If you want to know more about how to do the calculations on the risk-weighted balance sheet asset using the Basel II capital adequacy requirement, please look at the calculation video, which is a separate video uploaded to the YouTube channel. Now in this slide, we'll talk about the Basel III updates. Now remember that the Basel III has been implemented after the global financial crisis in 2007. However, since during the global financial crisis, a large number of banks went through several financial crises, and some of the banks couldn't actually survive during the crisis. So the Basel III has not been fully implemented yet. However, there are some changes in Basel III from the Basel II. Now we'll talk about these updates. So number one update is Tier 1 capital requirement of 6% from 4%. This is composed of 4.5% of CTI1 or the common equity and must be maintained at all times. The remaining 1.5% will be additional Tier 1 capital. So, which means that the requirement change in Basel III suggested that the Tier 1 capital requirement is 6% from 4%, and out of the 6%, 4.5 should be CTI1 or the common equity, and the remaining should be Tier 1 capital. Further, a mandatory capital conservation buffer, which is equivalent of 2.5% of the risk-weighted asset, has been implemented. However, remember that the Basel III has not been fully implemented as of 2019. So the capital conservation buffer has not been fully implemented for all banks across the globe. Please note, considering the 4.5% CTI capital ratio required, banks have to hold a total of 7% CTI1 capital from 2019. Further, a discretionary counter-cycle buffer 2.5% of the capital risk-weighted asset during the period of high credit growth need to be maintained for all the banks. Now, Basel II capital framework. Now, the Basel II capital structure has basically three pillars. Pillar 1 is the capital adequacy requirement. Pillar 2 is the supervisory review. Pillar 3 is the market discipline. Now, under the Pillar 1, which is the capital adequacy requirement, there are three approaches to measure the risk. So the three main risks includes in Pillar 1 the credit risk, operational risk, and market risk. So the credit risk are the risk that the borrower will not meet commitment when it's due. There are three measures, which includes the standardized approach, the approach which is calculated by the external rating agencies or the supervisors, and for the residential housing loan, risk weighted related to the loan to valuation or LTVR ratios. The second risk is the operational risk under the Pillar 1 capital adequacy requirement. So the operational risk is the risk of loss from inadequate or failed internal process, people and the system, or external events such as the internal and external fraud, workplace safety, business practices, damage to physical assets, and system failure. There are three main objectives to determine the operational risk. One is the operational objective, which is impact of loss of business functions, integrity and capability. Financial objectives, which is the losses owing to operational risk, exposes cost of recovering operational and ongoing financial losses. 3. The regulatory objectives, which is the prudential standard of bank supervisors. The third risk is the market risk, which is risk of losses resulting from changes in market rates in foreign exchange, interest rate, equities, and commodities. Now there are two different types of risk that can involve the market risk. One is the general market risk, which is impacting the overall market for the interest rate, equities, and foreign exchange and commodities, and the specified market risk, changes in the value of a security owing to issue of specific factors, or the factor affects only interest rate, equity position of an institutions. And the second pillar of the Basel II is the supervisory review of capital adequacy. This intended to ensure that the banks have sufficient capital to support all risk and encourage improved risk management policies and practices in identifying, measuring, and managing risk exposures such as risk incomplete, not captured in Pillar 1, and factors external to the bank like changes in business cycle. So it's basically any risk which cannot be captured on the Pillar 1, this must be captured in Pillar 2, which is the supervisory review of the capital adequacy. Additional risk management practices such as education, training, internal responsibilities, delegation and exposure limits, increased provisions and reserves, and improved internal control and reporting practices. The third pillar of the Basel is the market discipline. Market discipline aims to develop disclosure requirements that allows the market to access information on the capital adequacy of an institution. So the third pillar of the Basel III determines the market discipline and information disclosures of any particular companies or any particular bank. So the bank needs to make sure that when they're doing the disclosures, they're giving the disclosure at the highest quality. There should be transparency. There should be a risk management procedure and capital adequacy for each of the banks or the financial institutions. Now that ends our lecture for today. Hopefully you enjoyed the lecture. Please do not forget to subscribe my YouTube channel if you like this lecture. Thank you.